Hey everyone! Something important is happening in the precious metals market right now, and I don't think most people are treating it with the seriousness it deserves. In the last 24 hours, silver is up about 2.8%, sitting around $83 an ounce. Gold is also higher, around 5,056 an ounce, up about 0.6%. That's not just a nice up day. That's a signal. Because when silver moves like this, fast, aggressive, and ahead of gold, it usually means we're not in a calm, normal market anymore. We're entering what I call a high volatility regime. And in a high volatility regime, the rules change. The easy assumptions break. The fake confidence gets punished. And the people who aren't positioned mentally or financially for big swings end up making the worst decisions at the worst time. Now here's the part mainstream commentary tends to miss. High volatility isn't just noise, it's information. It's the market telling you the system is under stress, positioning is crowded, and the next move could be far larger than what you've seen so far. So let's talk about what today's silver move is really saying, why this could be the start of a different phase, and what you should be watching next. Without hype, without fantasy targets, and without pretending anyone knows the future with certainty. What you're seeing isn't typical volatility here. Let me show you the three factors that converge today. First, silver's move itself is a clue. Silver isn't just a precious metal, it's a hybrid, part monetary metal, part industrial metal, and part speculative instrument. That mix makes it explode when liquidity and sentiment shift. When silver jumps nearly 3% in a day, while gold is only up about 0.5%, it often means one of two things is happening. Either investors are rotating into higher beta hard assets, basically choosing the more aggressive metal because they think the trend has legs, or traders are getting forced, stops are getting run, positions are getting squeezed, and silver, because it's thinner and more leveraged in futures and derivatives, moves harder than people expect. And when that kind of move starts, it doesn't usually stay polite. It tends to stay volatile. Second, the macro backdrop is unstable, and that instability shows up directly in metals. Gold and silver don't trade in a vacuum. They trade against interest rate expectations, the dollar, and real yields. Basically, the opportunity cost of holding something that doesn't pay interest. When the market is arguing with itself about what the Federal Reserve will do next, metals can whip around violently. You'll get days where gold looks unstoppable, then it sells off hard, then it snaps back again. Not because the fundamental story changed overnight, but because expectations did. And right now, expectations are fragile. You can feel it in how quickly narratives flip from rate cuts are coming to rate cuts are delayed, and back again. That kind of environment creates violent repricing. And violent repricing is exactly what a high volatility regime looks like. Third, the structure of the silver market amplifies everything. Silver is one of those markets where small triggers can create big effects. You have heavy futures participation, large leveraged positions, and a constant tug of war between paper positioning and real physical demand. So when price starts moving quickly, it's not just buyers and sellers. It becomes a chain reaction. One group gets stopped out, which forces buying or selling, which hits another level, which triggers more forced flows, and suddenly you've got a move that feels like it came out of nowhere. That's why silver can look calm for a while and then turn into a monster. And today's plus 2.84% move is exactly the kind of wake-up signal that often marks the beginning of that phase. Now let's stack the evidence, because I don't want this to be vibes. I want this to be something you can actually use. Smart money is already positioning. Let's start with the institutional reality that almost nobody talks about clearly. Gold has a buyer in the market that doesn't care about your day-to-day emotions, central banks. And when a central bank is a steady buyer, it changes the entire tone of the market. It creates a baseline bid. It doesn't mean prices can't fall. It doesn't mean volatility disappears. But it does mean that dips can get absorbed faster than people expect. When you combine that kind of institutional buying with a market that's already jittery about the dollar and rates, you get a different kind of price behavior. Gold stays supported more than people think, and silver becomes the pressure valve. Silver is where the emotional energy goes. It's where people chase. It's where people panic. It's where leverage shows up. So the high volatility regime often looks like this. Gold acts like the anchor, silver acts like the whip. Now here's why this matters for you. In a high volatility regime, silver doesn't move in smooth lines, it moves in bursts. One day it rips 3%, then it drops 4%, then it rips again. And if you're not prepared for that psychologically, you'll do the classic retail mistake. You'll buy after the rip because it feels safe, then you'll sell after the drop because it feels scary. Volatility turns your emotions into attacks. Now, the technical side of this is where people get lost because they think technical analysis is some magical prediction tool. It's not. It's a language of behavior. So I analyzed the price action, and here's what stands out. Silver being around 83 after a nearly 3% 24-hour jump is not a small detail. Levels around whole numbers and recently traded zones matter because that's where a lot of traders place orders. This is where you get two possible paths. Path 1. Silver holds the current zone and starts building higher lows. In plain English, that means dips get bought faster and faster. That's what happens when the market is transitioning from sell the rally to buy the dip. If that's what we see over the next few sessions, it tells you demand is stepping in aggressively. Path 2. Silver fails to hold this area and snaps back down quickly. That doesn't automatically mean the bull market is over. In high volatility regimes, fakeouts are common, but it would signal that leverage is still too high and weak hands are still getting shaken out. Either way, volatility stays elevated, and that's the point. Now let's go fundamentals, because silver isn't just a story metal, it's a real material used in the real world. Now let's talk about the fundamentals, the real supply and demand picture. Silver demand is being supported by industrial usage in areas that don't just disappear because sentiment changed. Think electronics, think energy infrastructure, think manufacturing that still needs the metal regardless of what a trader feels on a Tuesday morning. And on top of that, investment demand is a swing factor. When investment demand comes back, it doesn't politely add a little. It can overwhelm available supply fast. Here's the critical part. Silver supply doesn't respond quickly to price. A big chunk of silver production is a byproduct of other mining, like copper, lead, and zinc. That means even if silver prices rise, production doesn't necessarily surge immediately, because miners aren't primarily mining for silver. So when demand spikes either from industry or investors, the market can tighten faster than people expect. And in a tightening market, volatility increases, because price becomes the rationing mechanism. If you've never thought about it that way, it's simple. When there isn't enough supply at a given price, price has to jump until sellers appear or buyers back off. That process is not smooth. It's jumpy. Now let's tie all of this to the high volatility regime idea in a way that's really practical. A high volatility regime is basically when the market stops behaving like a stable auction and starts behaving like a stress test. Prices move faster, reversals are sharper, headlines matter more, positioning matters more, liquidity matters more, and silver is one of the most sensitive instruments for that environment. That's why you can't treat silver like a sleepy long-term hold where you never check it. Even if you're a long-term believer, you still need to understand the environment you're in, because volatility determines what kind of decisions you'll be forced to make. Now let me give you a historical parallel, because this playbook has run before. I've tracked this pattern through multiple cycles. Back in early 2020, markets went from everything is fine to liquidity crisis in what felt like 5 minutes. And what happened? You saw these violent drops where people said, that's it, it's over. Then you saw these violent rebounds where people said, it's unstoppable. That's what high volatility regimes do. They create emotional extremes in both directions. In 2011, silver became a textbook example of how quickly this metal can move when speculation and momentum collide. It didn't just trend, it sprinted. Then it snapped back. And here's the psychological mistake most people made in those periods. They thought the first big move proved the whole story, so they went all in emotionally. Then the reversal disproved the whole story, so they bailed at the worst time. Volatility doesn't just move price, it moves people. So when I say high volatility regime, I'm not just describing candles on a chart. I'm describing what happens to your decision-making process. Now, the key difference today versus some past periods is that we're dealing with a world where central bank behavior, geopolitical tension, and rate expectations are all active at the same time. That mix keeps uncertainty elevated, and uncertainty is fuel for volatility. Let's make this personal, because none of this matters unless it connects to your money. Here's what this means for your portfolio in real dollars. If you're holding silver exposure, whether it's physical, an ETF, or miners, moves like plus 2.84% in a day are great when they're in your direction. But the flip side is, the same market that can give you nearly 3% up can also take 3, 4, 5% away in a blink when positioning unwinds. So imagine a simple scenario. Let's say you have $10,000 of exposure to silver-related assets. A 0.84% move is roughly $280 in a day. That feels good. But if the next day it swings the other way, you can lose that just as fast. And that's where most people get chopped up, because they start reacting instead of planning. If you're holding miners, the volatility is usually amplified. A 2 to 3% move in silver can translate into much bigger daily swings in miners, because miners are businesses with costs, margins, hedging decisions, and investor sentiment layered on top. That means, in a high volatility regime, miners can feel like a roller coaster, even if you're right on the metal long term. So the real question isn't, will silver go up eventually? The real question is, can you survive the volatility without making self-destructive decisions? Can you avoid chasing green candles and panicking on red ones? Can you size your exposure so you can stay rational? Because the market doesn't just reward being right. It rewards staying in the game. Now let's bring it back to what you should watch next, starting right now. The question isn't whether volatility continues. The math is clear. When silver is already moving nearly 3% in 24 hours, the environment is unstable. The real question is, are we seeing a transition into a sustained uptrend, or are we watching a sequence of violent shakeouts that will reset positioning before the next leg? Here's what I'm watching. 1. Does silver hold the current area around 83, or does it give it back quickly? 2. Does gold stay firm above 5,000, or does it start reacting negatively to shifting rate expectations? 3. Does the overall macro mood shift toward risk-off or reflation, because silver behaves very differently in those two worlds? And I want to be very clear, I'm not telling you to buy or sell anything. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the data tells a story. Silver up plus 2.84% to about $83. Gold above 5,000, and a market that's still sensitive to rates and the dollar. That combination is exactly how high volatility regimes begin. All right, before you go, 3 quick things. 1. Drop a comment below and tell me where you're watching from, and give me your prediction. Where do you think silver is headed by the end of this month? 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype so the algorithm knows you're here for the original. 3. Next video drops soon, and I'm covering the one indicator that tends to flash before the biggest silver moves. The last time it lined up like this, volatility exploded. You won't want to miss it. See you there.